Okay, so after the markets closed on Friday, the president came out and announced that, those tariffs on Mexico that were supposed to go into effect on Monday? Yeah, they're not going to happen. Now, this is great news for not only U.S. consumers and for Mexican workers, but also for the much beleaguered automotive industry, which has had to lay off quite a few people recently. The auto industry around the world really is not doing very well. And one of the ways that the automakers make ends meet in America is by having a sort of a cross-border supply chain with Mexico. There are parts of cars that are made in Mexico and then shipped back to the U.S. and they do something else to them and then they ship them back to Mexico. And the whole production process that crosses back and forth quite a few times. And if it's accumulating a tariff every time it crosses the border, then that would really have hurt the automakers at a time when they're not doing well, because really the automotive bubble is popping, and the value of cars are about to plummet. Back when the Fed had interest rates at zero for quite a few years, that created a huge subprime auto loan bubble in the same way that there was a subprime mortgage bubble back in the day. Now, these Mexican tariffs are much bigger, however, than the auto industry. I think that this tariff war that the president opened up a couple weeks ago with Mexico, saying that he was going to put a 5% tariff this coming Monday on Mexican goods if Mexico did not, do more to try and stop illegal immigration into the U.S. I see this as sort of a proxy trade war. I don't think that the president's target was necessarily Mexico, but I think that this was a part of his wider strategy to try and get the Fed to cut rates. The president knows that the Fed, before, when they were hiking rates, were hiking the economy right into a recession, which at this point I think is inevitable, but the president still thinks can be avoided if the Fed were to cut rates. So therefore, the president was trying to put as much strain in the short term on the economy as possible, so that the Fed would feel not only that they can't keep raising rates, but in fact that they would have to cut rates to compensate for the president's trade wars. I think that a lot of this trade talk pessimism that's been going around has been really intentional on the part of the president. He's trying to make the Fed think that they have to cut rates as soon as possible. And this week, the Fed sounded much more dovish. Jerome Powell came out and he said he will act as appropriate to ensure that a recession never happens again in our lifetime, essentially. And other Fed officials have been coming out basically saying that, I think it was Druckenmiller who came out and said, if there's a weak jobs report this week, we're going to cut rates. That's just a foregone conclusion at this point. And of course, this week we got a weak jobs report. Only 75,000 jobs were created in the month of May versus 180,000 expected. So that's a very weak jobs report. So the president, now satisfied that the Fed will cut rates based on what the Fed officials have said, decided to call off the trade war, and he was able to hammer out a deal with the Mexicans to avoid putting tariffs on them, which it seems to me he may have never even intended to do in the first place. And to be quite honest, the markets rallied so heavily this week on the hopes that the Fed will cut rates because of the poor economic outlook. The president probably just thought he didn't want to add anything else to the concoction that may have disrupted this great rally. Stocks were doing well enough as it is. He didn't need to try and put in these Mexico tariffs to try and force the Fed to cut rates even more, considering that the Fed doesn't have very much that they can cut. As far as rates go, we're only at 2.25% right now. Some of you may remember that when the last economic bubble popped, the Fed had rates at 5.25%, so they had quite a bit that they could cut. That's not the case this time. The Fed's pretty much out of ammo. They're going to have to go right into QE4, and they're probably going to start doing what Japan does, which is, buying up stocks to directly pump up the market. I mean, I wouldn't be shocked if we see the Fed with $1 trillion on its balance sheet holding SPY. Now, unfortunately for the president, by the time that the Fed ever gets around to cutting rates, it's already far too late, because by the time that the Fed realizes that there's going to be a recession, we're already in one. So I would not be shocked, not only if we have a GDP print this quarter that is under 1%, but we very well may be in a recession by the end of the year, despite anything that the Fed does to cut rates. I mean, rate cutting is not going to be enough to stimulate this economy, because based on the hopes, after the Fed cut or decided not to stop raising rates. Mortgage rates, for example, actually went down as far as the market rate goes for getting a mortgage, and that did not stimulate mortgage applications. People are buying less homes despite mortgage rates coming down quite a bit. I think you can get a mortgage under 5% now, and that's a fantastic rate in any economy. So if people do not want to buy housing or cars with interest rates that are falling already, then the Fed cutting back to zero is not going to do enough to turn this ship around. We're already going over the cliff. And frankly, I think it will be very challenging for the president unless he's able to convincingly blame other people like the Fed, who, I mean, to be fair, the recession will be the Fed's fault anyway, because the Fed created the bubble that is now bursting. But I think it'll be very difficult for the president to make that case. But if anybody can make that case, it's probably this president. I think he'll be able to convince a lot of his base that the Fed is responsible, although he'll convince them for the wrong reasons. He'll say the problem was that the Fed raised rates when they shouldn't have, which, I mean, the problem was that the Fed cut rates to begin with. But I have to say, this most recent market rally is really absurd, if you ask me, because the logic here is that the economy is weakening, so the Fed's going to cut rates. So people are buying stocks. I mean, if the economy is so weak that it can't handle 2.25% interest rates, well, then it's not particularly strong to begin with, and you should be selling everything you have. I mean, these traders are absolutely nuts. I guess the problem is most of them have been working on Wall Street since after 2008, and they don't seem to understand that the markets can go down even when the Fed doesn't want them to. I guess that the Wall Street theory of the business cycle is that recessions happen when the Fed decides to create a recession, which again is true, but not for the reasons that they think. The Fed doesn't decide when we're going to have a recession. They can try and juice the market for as long as they can to push it off, but eventually there's going to be a recession whether the Fed wants there to be one or not. They think that after the maestro Alan Greenspan and Ben Bernanke with his fabulous QE program saved the markets. They think that markets can never go down now. They think that the Fed has completely defeated the business cycle. They've grabbed that bull by the horns, and they didn't get the snot. So I think that'll about do it for today. If you got anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day, and I'd hate to have you miss one. So I'll see you back here tomorrow.